Hey guys, John DeRelay, Head of Revenue Management Education with Wheelhouse. And today we're going to continue our data deep dive series by looking at Sevierville, Pigeon, Gatlinburg markets. Really excited to dive into the data today. And hopefully you guys will find some great opportunities to improve things in your own portfolio. So let's go ahead and dive right in. What I've got pulled up first is the market reports for Sevierville, Tennessee. Now, in Wheelhouse, Sevierville and Gatlinburg and Pigeon Forge is a pretty wide-ranging market area. You can see here that we're basically covering all of the Gatlinburg and Dollywood areas, but we're also got some stuff out here. Now, even though the range is pretty high, the majority of these listings are centered right here in Gatlinburg and Pigeon Forge. These areas are included, but as you can see from the numbers, we go from like 3K, 3K, 2K. The numbers are very small. So even though we are covering these areas, the vast majority of the data is coming from the primary Gatlinburg Pigeon Forge spot. Now, just glancing at some of the highlights, it's kind of interesting to see this is a market that obviously has a lot of listings overall. And even with all of those listings, we're seeing a pretty big substantial increase year over year in active listings. So lots of inventory entering this market, lots of production. And just at the high end, we're seeing the occupancies kind of feel that pressure. So if you've been looking at kind of macro data from some of the big data partners in the space, we've seen that a lot of markets have really high amount of new listings. We're seeing aggregate demand increase, but in many cases, that aggregate demand is not increasing at the pace of the properties. And when we're looking at this kind of Sevierville area, that's the case. We have 26% year over year increase in active listings. Occupancy itself is only is dropping 8%. So feeling the pressure of that. Now, we are seeing some increases on the ADR and RevPAR side as we see some of that inflation get built in. Keep in mind, some of this may also be changes to the way people are showing their rates and the way they're distributing prices since Airbnb stopped allowing so many fees, and in some cases, fees aren't even visible. So we are seeing some price increases, which make up for the lack of occupancy. But whenever occupancy is down, at an aggregate level, you might see that the market is up a little bit. But what might really be happening here is some people are up a lot because they're getting booked and they're doing so at a higher rate. But then a lot of other properties may be going unbooked. So you see this really big separation between really well-performing inventory and then people who end up vacant. Now, we're looking at all the properties. If we just go to the top end where we're really going to look at the top, 15 to 20% of listings, you can see that on the map, it really cut out all of the really surrounding stuff. There's only a couple out there. We're not going to look at the active listing part of that because we really need to look at the all. But I think what's most interesting is we're still seeing this occupancy pressure, right? So even in the highest performing groups, the occupancy is down. Now, they have a lot higher occupancy overall. You can see it's at 70% instead of, I think where it was like 50%. So those high performers are still staying booked a lot longer. But as a group, we're still feeling that occupancy pressure. Now, interesting to note, we're seeing much higher ADR increases in this group. So even though that occupancy pressure is there, these top properties in the marketplace are likely doing pretty well. And so when you're talking to your friends in the market or you're talking to owners may be getting very different perspectives of what's going on. You may have owners that are saying like, yeah, we're doing great. The market's super up, what are we doing next? You might have owners that are talking to those owners and being like, hey, my buddy says he's doing super well. What the heck is going on? And they may not see the whole picture. So being able to pull this apart for owners and for your own teams to show them like, hey, there probably are properties that are doing really well. Occupancy may be down, but we're able to recover that through ADR. But that's not the whole story. Because when we look at everything, we also know that occupancy as a whole is down. It's even down in the highest parts. That means a bunch of properties are unbooked. And figuring out how to tell that story is going to be really, really key. One thing I do want to take a quick look at, and this is a really cool kind of back-end tool that we have at Wheelhouse. As I said before, Wheelhouse has this area as a very large market area. But within our model, we actually are breaking this down into various clusters. So it's helpful for us to just kind of take a look at what clusters are actually existing in the marketplace. So each one of these colors is going to be a cluster of listings that our model is generating slightly different seasonality for and taking into account slightly different listings. And I think what's most interesting here, some of these clusters are going to be more spread out because, we're finding booking trends or, that kind of thing. Do keep in mind that the model that's doing this doesn't see the map. So it's really doing this through booking trends. And we've got a few big clusters here that make quite a bit of sense. I think we've got this cluster number 4 that's looking pretty big around Sevierville and into the bottom of the Great Smoky Mountains. We've got, let me see here. We've got this yellow cluster that's also spread out around Sevierville. And I think, and then we've got this green one, which is really going to be centered around Dollywood and Pigeon Forge and really kind of pulling those all together into one group. So quite a few interesting kind of areas. But I do think that those big ones, the red and green in particular, and a little bit of the blue are going to be the really big central ones around Pigeon Forge and Dollywood. This is always interesting just to kind of look at in a large market. I think it's especially helpful when you have like things like Ski and Lake. But for now, we're just going to see how the Wheelhouse model is kind of grouping these properties and help you get an idea of who you might be competing with, especially if you're in a little bit more outlying areas, because you can kind of see here like booking trends seem to be fairly similar in these outlying areas, even though the areas themselves may not be particularly similar. So jumping back over our market data, first place we're just going to hop over is just to kind of the trends section, and we're just going to look at how occupancy has been kind of coming together in this market over the last couple of years. So looking at this, you can see that when we just look at the last 2 years, we've seen a little bit of attrition in the market, but it's also been pretty mixed. So Q1 was down into Q2, recovered a little bit in May, down a little bit in summer, but then kind of picked up and had similar performance, if not in some cases better performance at the end of Q3 and Q4. Pretty interesting. I work with a few clients and I actually do some revenue management for a property in Gatlinburg myself. And I felt like this market is one of the most unstable markets in terms of booking window and seasonal trends that I've really encountered. Like, you usually can expect things to come in, but it seems like sometimes the dates that you would expect to be really high have really unstable booking windows. They're not really following year-over-year trends. In fact, even some of the months that seem to be the highest quality and price months aren't always following trends. So I think that's probably continuing in here. And we can see a lot of that volatility, a lot of that up and down when we're looking at last year. In addition to that, there's a few spots that actually have high seasons. We obviously have a spring and a fall high season and a summer high season. I think when we break that down into different parts of the market, you may see different clusters like we looked at getting different high seasons. But at an aggregate level, it looks like we've got a pretty up and down market. And so it makes sense that volatility would translate all the way down to the revenue manager. Now, if we look at what's going on in 2025, you can see we're off to a pretty good start so far. January, looking really good compared to 2024. We're seeing occupancy increase a little bit. Obviously, it's going to be a low season, so a lot of people are still going unbooked, and we're not quite capturing that 2023 occupancy, but I think most of us across really most markets in the United States are pretty resigned to that being the case. Now, if you've seen any of the data coming out of Key Data, particularly the presentation at DARM, I think stabilization is the name of the game. I would expect us to see a really similar situation to 2024 this year, barring any big macro things. And it looks like as we go forward into the future, we might be kind of seeing some of that. We are seeing pretty good on the books for February. It looks like we might be able to get into where we were last year. Now, looking forward into March, though, it does look a little light to me. I mean, we're 45 days out from March, and we've got quite a bit of ways to go as a market. Now, if I hit this over to the high portion, we can just see if there's any differences. most of the trends look pretty similar. Most notable, I think, is that March still seems to be dragging compared to where it ended, although it does look like it's a little bit higher. So 27% compared to 77%, that's about a third. And then if we look at this, or about a third, maybe a little less. So it's maybe pacing a little better, but it still looks like it's a long way to go, considering how close March is. There is actually a good little way that we can kind of spot check this. So let's take a look here. Let's go over to the historical lead time distribution. And we're going to go put this over in March 2024. And if we go to 45 days, we can see it was about 68.1% had a higher lead time. So that's going to be about 22%. No, sorry, 32% were booked prior to that. If we take that 32% and we apply that to where we ended last year at 77%, that gets us to about 24.6%. So that's actually quite good. If the market was at 26.4% last year and we're at 27%, we are pacing a little bit ahead. So maybe those concerns I had about pace aren't as big of a deal. It is a pretty short booking window for this kind of spring period, and it does look like that pace is there. Now, if we look at the same thing for, that was the high performing group, let's just take a glance at how that looks for everybody. We've got 58% ending last year across the entire market at large. We'll go over here to the historical lead time. We'll go to March 2024, and we look at 45 days, and we had about 23% on the books. Let's do this one, sorry. We had about 29%, 28.5. That puts us at about 16%, which that pace actually is just about on. So we're slightly pacing ahead. Now, the question becomes, if the market is slightly pacing ahead, but we've seen some downward movement, or you're one of those people who are getting the vacancy, you really kind of need to beat that in order to do better. And since getting any occupancy if you were vacant is going to result in more money, my advice to anyone, basically if you are booking, be really sensitive to the rate, because there's not a lot of room to miss the booking window as it comes in right now, especially as the market's kind of pacing on track. There's a lot more room to go down. If you're not pacing well, you really need to correct, because that booking window for the rest of the kind of market is going to hit soon. And if anything changes and things get worse, you could be in trouble. The next thing I kind of like to look at just at this trend section to get an idea is the asking rate section. So asking rate is going to be what Wheelhouse is observing in terms of advertised rates. So the rates that people are posting on OTAs, the rates that they're putting out there as their kind of rack rate. And looking at this, we have a few things here. So we can see that January ended up being pretty similar to last year with a little bit of growth. That makes sense that we wouldn't see much rate growth in the winter. It looks like people are already adjusting a little bit, and that February is actually coming in a little lower, which is pretty interesting. But then as we get into March and April, we're seeing those rates start to crawl up quite a bit, particularly in April and May. And I think this is a big kind of point. We are pacing, so it makes sense in March that we would probably be in a similar spot. If you are not being booked, you really need to consider undercutting that. I think looking at the April and May sections, though, it's a little bit interesting that that rate is crawling up so much, because when we look at these occupancy values, May in particular, and even April last year, were much worse occupancy performers than March. And the fact that the market is holding these rates almost equivalent, you see March, April, May are almost all in the same spot, really didn't match the consumer's behavior last year. And really, it offers people a great opportunity. Because if you're going to bring these rates down closer to what you were doing last year, or even if you had vacancy undercutting what those kind of averages last year, you might be able to capture a much earlier booking window for these properties and actually fill occupancy that you otherwise wouldn't have had. Because there's vacancy in the marketplace, there's room for you to sell it more properties at any rate and potentially capture more revenue overall. Now, as I've been looking at other markets, I'm pretty sure it's here too. It seems like consumers are very, very willing to be much more flexible about when they travel, but the rates have to be right when they're looking. So a lot of people are like, hey, I'm not going to travel at the peak times, or my wallet's, a little bit squeezed, so I need to pick a different time to travel. When they decide to make those plans, they're not just going to look at your market. They're going to go, hey, should I go to Gatlinburg, or maybe I should go down to Destin, or maybe I should go to Charlotte, or maybe I should go to Nashville. And they're going to look around and find, hey, if I'm traveling these seasons, what's going to be a good rate for me? And so if you have the right rate further out, particularly in these seasons that are a little bit lower, like April and May, you may be able to capture those people who are going to be much more flexible about when they travel. But the key is you need to have those rates out there now. You can't wait until the last minute, because you won't have any advantage as everyone else drops their rates too. So this is a big kind of opportunity, I think, that I would encourage people to look at in this marketplace. Is, at a market level, the March, April, May rates seem pretty similar in terms of what we're seeing. And that means you have an opportunity to just try to capture anyone who's looking, and you still have time to get your normal bookings during the regular booking window. As we go a little further out, we're seeing pretty high rate increases across the board into summer and beyond. Now, I would expect rates to be pretty high out here because it's so far in advance, but even these summer increases are a little bit of a concern for me. I think that, like, if pacing is good, then and you're getting production, that seems reasonable, but you're not building in a lot of opportunity for any downside. So if there's macro market conditions or anything that happens that would cause travel to reduce or demand to reduce, that pacing behind, any starting to pace behind will become really bad. Now, these rate increases are really, in my mind, optimistic. It's the market saying, like, hey, we think that this year is going to be really, really good. And so we want to hold rates really, really high, because either the consumer will pay it, or we don't want to sell too early because we expect rates to be higher. Ask yourself if that matches how you think things are going to go this year, when you've looked at how the market's been year over year and how things have kind of attritioned. Do you think that this year is going to be significantly better than next year? If you do, go ahead and keep high rates in the future, follow the market, hold out. But if you have some concerns based on how last year kind of came together, and you're a little bit worried about it, maybe consider taking a look at your own rates, making sure they're more in line with last year, definitely doing it in stuff that sold at the last minute last year or didn't perform as well. Use those to try to build more occupancy pace than the market. If the market ends up being really good, when you hit the main booking window, you're still going to be able to optimize those available properties. But having a little base of business, I think, is going to be really helpful if you expect any downside. Let's just take a little deeper look here at the occupancies at a daily level. I like to do this particularly because spring can be so volatile in so many markets. And I think what's most interesting here is when we look at this zone in March and April, really what I'm looking for is how the shape of last year's occupancy, how that came in, looks compared to kind of our early booking. Last year we had this really big kind of like early mid-March spike. Then we had this big end of March all the way through the first week of April, which was Easter, really spiking up strong and driving the majority of the revenue. You can see there's these really low occupancy dates. We're not quite seeing the same shape appear in the early bookings for March. You can see here, if I zoom in a little bit, that we're getting some spikes in this early April, so that's starting to build up. But oddly enough, they're keeping pace with this middle of March time period. So we don't have the same big low swing, high swing, low swing quite the same way. It's much more even from April 7th to April 28th. Now, this could be because of a variety of factors. Because Easter is so late this year, spring breaks may not be aligned, so we may not be seeing the same kind of compression, but we may see more dates have more demand. That's really important because if not everyone is going to be traveling on the same weeks, you may have less pricing power, and that may become really evident as we get into the next couple of weeks. But it does mean that we may have other weeks that you can price really well. Now, we also want to keep in mind here that Easter is moving, so we probably won't be able to have any pricing power over this week, but we should start to see some pickup later in the month. Now, this is an unknown because, as you can see, April isn't super strong into early May. We're starting to see a little bit of buildup around this time, but it's not spiking up like it was early. So that's really a big unknown is, what rate do we do for Easter? Are we going to get the same demand because of where it's occurring? And I think that you and your revenue management team are going to have to be asking yourself that question pretty consistently. Looking at how people are pricing, we do see, I think, the market responding pretty well in terms of overall trend. If we look at the overall shape in March, we do see a much more consistent pricing buildup over the course of March. It doesn't, basically the prices aren't following the demand from last year, but they are following a little bit better for the demand from this year. We do see those prices drop off during that kind of Easter week from last year, and we do see that premium building in a little bit later in the month. Now, it will be interesting if what kind of premium we can get here. I think that's still pretty unknown. I think it's right to expect a really high premium, but here and in a lot of other markets, we're actually not seeing the build up quite as fast as you might expect. Could just be a function of the booking window being much later because the dates are much later. I would like to point out here, though, is I do think this mid-April range, which maybe is going to be a little weaker, is probably priced a little high. As you can see, the market is essentially pricing this the same as mid-March right now. And we drop a little bit into early May. And so that's pretty interesting. Look at the occupancy situation for those dates. You can see early April here, early April into mid-May. The occupancy situation is nowhere near as high as these early and mid-March peaks. And so something I've been bringing up, which I think as an industry, we've taken a lot of these lessons and applied them to the fall, but we still continue to not apply them to the spring. Even though spring last year was pretty weak, it looks like there's some weakness in certain parts of the country this year. People are just not quite being conservative enough in this spring time period, because even though these occupancies are significantly lower in many cases, we kind of keep the rate position a lot more similar to these areas that we see. And, when we go back and look at how fall has been kind of, on par with the previous year or even a little bit above fall into winter, that's true in a lot of markets. And I think it's primarily because the revenue management practices are far more conservative. Awesome. Well, I hope you find that deep dive into the data to be helpful and that you have some good takeaways to be able to help improve your revenue for 2025. If you want to take a look at more of this data, or maybe take a look at some of this data with your own portfolio data, please feel free to hit up the Wheelhouse team. Thanks and have a great day.